Guys, the market is loud right now. There's red screens everywhere, big old headlines, a lot of noise, and while everyone's watching the market, what really matters is what all this noise is quietly doing to your money, your savings, and your long-term financial plans. Unfortunately, most people right now, they're focused on the wrong things, and they haven't really noticed that the shift is already happening right now. Now, stay with me on this video because I'm going to explain in plain language what's happening, and then I'm going to walk you through exactly what you should be doing right now with your money, your investments, and your debt, and even some of your big purchases that you may be considering. So first things first, what's happening right now isn't one big problem. It's a series of smaller things kind of stacked on top of one another, okay? This past week in the stock market, we saw real volatility, mainly in tech, okay? And this wasn't random, okay? One of the biggest drivers of what we saw in the stock market was Microsoft. Now, Microsoft reported earnings that looked okay on the surface, right? But investors didn't like what they heard about cloud growth slowing down and how much money Microsoft is spending on AI infrastructure right now. Microsoft dropped hard in a single day last week. And because it's one of the biggest companies in the world, that one move rippled through the entire tech sector. Software stocks sold off, the NASDAQ dropped, and we know the NASDAQ 100 includes or is heavily dominated by tech. Now, all this happened not because the economy collapsed all of a sudden, but because expectations sort of changed and shifted in midair. Now, here's the key that you have to remember about the stock market and other markets. Markets don't trade on reality. Markets are usually trading on expectations. Why do I say that? Because markets are looking into the future all the time. The stock market right now has already priced in future events, right? Things that haven't even taken place yet. Now that's key because that's what a business does. Remember, the stock market is just a collection of companies. And these companies got to be looking forward if they want to stay companies down the road. So companies and the stock market are always looking into the future. Keep that in mind. Now, just a couple of days ago, last week, we got new inflation data called the Producer Price Index, or what's called the PPI. The PPI tracks prices businesses charge each other, other businesses, before prices ever reach us, the consumers. Think of it like this. The PPI is the wholesale price tag on the entire economy. If it goes up, that usually means companies are paying more to make and move things around in the economy. And those costs often show up later in consumer prices that we pay. So the PPI report that came out showed that producer prices rose by 0.5 percentage point in December and are still running at about 3% increase year over year. Now that will likely translate into higher inflation and higher prices for us because it just trickles down. Goods prices were mostly flat. Energy prices were down. Food prices were also down at the producer level. But services, things like transportation, business services, travel, that's where prices are still sticky and remain higher. Now, when several signals hit at once, like we saw last week, earnings, bad earnings reports, inflation kind of staying sticky, policy uncertainty, markets don't just move, markets get confused. And it's that confusion that makes markets go down. And that leads directly to the biggest mistake that people are making right now. I'll say it like this. Most people think the risk right now is the market being down or the market being volatile, right? No. That's not the real risk right now. The real risk is being forced to act or do something when you don't even have margin for error. See, when you don't have savings, every headline feels what? Urgent, right? When you're buried in a bunch of bad consumer debt, every time the stock market dips, it feels dangerous. When you're overextended, volatility, it feels personal, right? This is why people get emotional with investing. Listen to me closely, guys. When you have $1 million net worth and you have $75,000 or $100,000 in savings and you're well diversified, you're not tripping about market volatility. See, here's the deal though. Most financial damage in your life doesn't come from these big old crashes happening out of the stock market. It comes from your reactions to the crashes. And your reaction comes from the fact that you have no margin for error. right? What I'm telling you to do in this video and on this whole YouTube channel is that you have to create margin for error in your financial life. That means budgeting, emergency savings, having a full emergency fund, getting out of bad debt, investing regularly, being diversified, adding some real estate to your portfolio. That's all to help you stop being emotional. Have some margin and chill out when things around you are going crazy out here in these markets, right? And I'm going to give you some things to do in just a moment. So bear with me here, okay? Let's go one level deeper because this is the part that most people really never hear in a real way. The stock market is not the entire economy, okay? GDP grows slowly. Jobs change slowly. Wages move even slower sometimes. Stock prices can go up and down fast. One day they're up, one day they're down, right? And sometimes they move way ahead of the real economy because, again, the market is looking forward. Remember, stocks are just simply reacting to what they believe future events are going to be. Now, this is important also. Over long periods, there's a direct relationship and correlation between economic growth in America and the stock market performance. But the correlation is really weaker than people tend to think, especially temporarily, right? That correlation is big for down the road, but in the 1 year, 2 year, 5 years, sometimes that correlation is not as easy to see. That's how you get periods when stock market prices run well ahead of economic growth, right? You don't always get an immediate crash. You get some fragility. You hear a lot of people saying that, oh, the stock market is overvalued and stocks are trading too high. And really that's true. But we have to understand that overvaluation of the stock market doesn't mean that there's going to be a collapse tomorrow. It really just means that there's less room for error for you right now in terms of your financial situation. When prices are stretched, right, like we're seeing right now in the stock market, good news has less upside and bad news just hits harder, right, when prices are stretched. And then that's when you see volatility increase, right? Volatility being those big swings up and down. Now, prepared people, they don't need certainty, right? If you're prepared, volatility can't really mess with you as much. When you're prepared, you already have your flexibility, and flexibility is what gives you options. And that's what we're trying to set you up with, is flexibility and options. So our job is to be prepared as investors, as consumers. No matter what's going on out here in the economy, we can handle it if we're prepared. See, once you understand that, the rest of what's happening right now makes more sense and is more tolerable, and you don't have to panic, right? Yes, it's already started. Money is moving and it's happening right now, but you can chill out because you've got your bases covered. Now, let's talk about the Federal Reserve real quick. The Federal Reserve's decision that we just got a few days ago, because this matters more than people realize. The Fed decided to keep interest rates exactly where they are, not because everything in the economy is okay and fine, and not because inflation is all of a sudden solved, but because inflation is still a little higher than they're comfortable with, especially when you look at prices at the business level, right? Which is what the PPI showed us. The Fed is not convinced yet that inflation won't somehow surprise us again. So their message was pretty simple last week. They're saying we're not in a rush. We want to see more data before we make another move. That's the Fed being cautious. Now, some people would say, hey, that's the Fed being overly cautious. And I'll let you make up your own mind on that. But either way, that decision adds uncertainty into the system. And that's where markets start to react. Not to mention the fact that Trump just announced his new Fed chair replacement for Jerome Powell. So you know that got the markets a little shaky as well. But here's an important point that a lot of people miss. Markets don't necessarily hate bad news. Check this out. Markets hate uncertainty. When investors don't know what's coming next, especially interest rates and who's making those decisions, prices start moving around. That uncertainty shows up in places that most people aren't watching. We saw the US dollar have some issues. We saw gold and silver last week swing sharply over the last few days, right? That doesn't mean go out and buy gold or dump stocks. It means money is repositioning itself. Big money is adjusting to the uncertainty that we see in the economy right now. Not panicking, right? Remember, these are just signals, not instructions on what you should and shouldn't do. There's signals that you need to know about. Now, on the job side, we saw weekly jobless claims still relatively low. That's important. Matter of fact, that's actually a good thing, right? Because it doesn't say the economy is falling apart, but it's just something that you need to be watching over time. Another piece to this puzzle, because these trends sort of matter. Okay, and then you layer in the whole recent tariff talk that we saw in the news last week. Those tariffs that are tied to countries like Cuba and South Korea, those tariffs don't hit all at once. They don't just show up overnight. They work slowly by raising costs inside of the supply chain, right? And when costs are risen and go up in the supply chain, those costs eventually show up in companies' margins, right? And all that trickles down to us, right? The consumer, where our price for the item goes up, which adds to inflation. So when you put all of this together, guys, what I'm saying is the Fed waiting before they change the rates. Then you have the dollar moving. Then you have the price of precious metals swinging. Then you have jobs holding pretty steady for right now. And then you have tariffs slowly pushing on the supply chain and cost. You start to see why the market feels loud right now, even though nothing is really broken, right? Again, what you're watching right now is just money repositioning, and you need to be aware of it. So now the real question isn't what the market is doing, it's what you should be doing with your money. What you should do is this. Now, this is the part of the video that matters the most, right? Because knowing what's happening in the economy doesn't help you if you don't know what to do with it. So let me say this clearly. When things get loud like they are right now in the economy, doing more is usually the wrong move. Now, let me unpack that, okay? The winners right now, they're not scrambling around figuring out what to do with my money and panicking. The winners aren't refreshing their apps every 5 minutes to see what's happening at noon on a Tuesday, right? They're not chasing the next headlines. The winners, they're getting their foundations right and in place. They're preparing, right? If you're a saver and you're trying to, in this season of life right now, trying to save up money, the priority right now is not about optimization. It's about stabilization. A lot of people are worried about squeezing an extra 0.5% interest point here and there. Listen, but while at the same time, don't even have enough cash to sleep well at night or to cover a $1,500 emergency, right? That's backwards. Liquidity buys peace, and peace buys patience, right? When your savings are thin, every piece of news is going to feel urgent. Every dip in the stock market is going to feel, personal, right? Every headline that you see, that you read on social media is going to feel like a threat to you and your money. But when you have margin, real margin, all that noise loses its power. You stop reacting because you don't have to react. And when I say margin, I mean money, all right? Emergency money. Now, if you're an investor, if you're investing through single stocks, ETFs, index funds, bonds, hear me on this, okay? Volatility is not a sign that something is broken. Volatility is the price of admission to this game called money and investing, right? You got to get used to it. Your edge in this game of investing is not about how intelligent you are. Scrap that. Your edge in this game of investing is not about trying to predict the next move or the next big stock. That's not it. Your edge is discipline and time. Your edge is patience. Your edge in this game of investing is consistency and being logical, not emotional. Big difference. Most people don't lose money because they picked the wrong stock, right? They lose money because they abandon a good plan during a loud moment in the markets. So if your plan made sense, your investing plan made sense 2 weeks ago, it probably still makes sense today, despite the headlines, okay? A loud week does not require you to go out and build a new investing strategy. Just keep that in mind. Now let's talk about debt real quick, because this is where a lot of people lose flexibility and they lose their margin because all their money is tied up going towards payments on bad debt. Bad debt removes your options. Bad debt is debt on anything that is not going up in value. It just makes you lose option. Listen, when you're carrying credit card balances at 20+%, the market don't even have to crash to hurt you. When you have a $600 a month car payment, the market didn't cause that, and the movement in the market can easily feel scary to you. When you carry bad debt, you're already hurting yourself in this game, right? So what I'm saying is you don't need a super duper fancy strategy. You just need no bad debt, an emergency fund so you have some cushion, and some margin, and you need some structure. That's why I always say attack the bad debt in your life as soon as you can. That way you get some momentum towards building wealth and you start building a buffer between you and what's going on in the economy. You create some breathing room for yourself, right? Listen, if you need help organizing your debt, I've got a free debt snowball worksheet with instructions in the description box below. No hype, just a simple free tool that can work for you and will help you. Now, let's talk about big purchases, because loud environments like we see are the worst time to rush into big purchase decision. When headlines are screaming at you, people tend to feel pressure to do something. Buy now, right? Lock it in. Get the discount. Grab it while it's on sale. Get the rebate. Beat the market, right? That mindset gets people in trouble, okay? Affordability matters more than timing. Cash flow matters more than headlines. If a purchase stretches your budget or adds stress to you or assumes that everything has to be perfect in terms of the conditions down the road for this thing to work out, it may not be a smart move right now. As an investor, remember, patience is a strategy too. And here's the out-of-the-box truth that most people don't want to hear. The people who win in economic environments like we're in right now, they're not doing more, right? They're actually doing less. And ultimately, in the long run, they'll be doing better. They're just out there protecting their margins, staying disciplined, living within their means, giving themselves some time and patience, right? And that's how real wealth is actually built. It's not built by looking at the headlines and saying, oh, this happened, so I got to do this. No, because the market is likely going to stay loud. Politics are going to stay loud. Social media, we know it's going to stay loud. Your job isn't to predict what's happening next or predict the best stock to buy. Your job is to position yourself so that you're not forced to react emotionally. It's already started. Money is moving, right? You just have to have some margin, some discipline, some patience, some consistency. That's how you're going to win when everything around us is noisy like it is right now. That's why I like to emphasize that these aren't political videos, because I'm not here to report headlines or tell you to lean left and lean right. I'm here to translate what's happening in the economy into our own personal money decisions so that we can make more, we can save more, we can invest more, and we can leave more. Now look, I hope this video was helpful to you. Let me know if you got value in the comments below and what stood out the most to you about this information. And if you want a clear system to put your money in the right order, enrollment is open right now for my 4-step financial reset. It's a guided reset with instruction, a workbook with 120 plus financial reflection questions, 16 fillable handouts, and 3 live group coaching sessions starting in a little over a week, where I walk you through long-term wealth building without hype, without panic, without trying to guess. It's a chance for you to build your own strategy with help from me. Now, if this video helped you focus, please do me a favor and share it with someone who needs clarity with this economic noise and their own money right now. Listen, the best person who's going to take care of that old you is the young you. Until the next video, peace.